For more on jobs and what this means for the Fed, let's bring in Apollo chief economist Torsten Slok. Torsten, it's great to have you back on the show. And this is exactly where I'm going to start with you, because we had this strong top-line number addition of jobs today. But we also saw that wage growth is continuing to slow and labor participation is holding steady at a slightly higher level than what we've seen in months past. Your take?
Yeah, no, I mean, the headline number was certainly higher than consensus expected and also what I would have expected. If you look at the household survey, they came in much weaker at 86,000 jobs created. So it was a little bit mixed when you compare what's going on in the establishment survey, meaning the survey of companies, relative to the survey of households. The other dimension, other than exactly what you're highlighting, the strikes, is also that the response rate for the establishment survey that gives us the main number is only around 40%. So there's all kinds, before the pandemic, that was more like 60, 70%. So there's all kinds of statistical issues you can begin to worry about, but that doesn't deny the main issue here that, as you're highlighting, it was a reasonably strong report. It was still the case the unemployment rate moved sideways at 3.8 again in September. We also had 3.8 in August. So combined, as you highlighted, with wage growth still getting a little bit better from 4.3 to 4.2. Yes, at least this was not the month where the economy was starting to really slow down more meaningfully. But still, let's not forget that the Fed is trying to slow the economy down. That is having implications for delinquency rates for consumers. It's having implications for high yield and loan default rates. So viewed in the broader perspective, we should still see this as a process where we'll have some bumps on the road while the Fed still tries to get inflation under control.
Yeah, I want to get into that a little bit more. But first, is it clear that wages actually fuel inflation? And I ask that because, yes, we're seeing wage growth moderating. But for the longest time, inflation was outpacing that wage growth. And maybe that's changed a little bit here now. But it also seems like as workers are able to ask for more money, that's also keeping the economy in a better place than I think many people, at least at the start of the year, would have expected.
Oh, that's absolutely correct, Morgan. I mean, wage growth is very critical, of course, for income growth and therefore for spending, and therefore with spending making up 65, 70% of GDP, therefore for the overall economy. There are some issues about, to your question, what matters for inflation, in particular services inflation, is indeed wages. Think about it when we go to a restaurant, even when you stay at a hotel, the vast majority of costs for companies are labor. And that means that when wage growth is still strong at 4.2, that's still a reasonably high level when you compare that with from 2010 to 2020. Wage growth for that period was between 2 and 3. So yes, it is coming down, but I still think that it's completely in line with the messaging from the Fed more recently that it's too early to hang up the banner of saying mission accomplished, because there's still too many problems with wage growth. Is still a little bit too high. Inflation that came out last week, 3.9 on core, is still a little bit too high relative to the 2% target. So the Fed would look at this and say, well, if this is the case, we'll just keep on being hawkish and saying higher for longer, which is what the market is reacting to today.
Yeah, I mean, there's so much attention and focus paid on whether we're going to get another 25 basis point hike or whether the Fed is actually done. But to your point, higher for longer and how that extends into 2024 is really going to be the key because of the impact that's going to have on things like corporate debt and then in turn, ultimately, the labor market and the state of this soft landing. Do you think a soft landing is actually going to be attainable? Or if when you think about higher for longer and a Fed funds rate at what? 5.25%, 5.5%, even as inflation comes down, is recession inevitable?
No, I do think that recession is inevitable because the whole reason here why markets are getting a little bit more optimistic is that we still have incredibly tight credit spreads in IG, high yield loans across the board. But think about it. What's going on is that yields in fixed income have become very juicy because the base rate has gone up because the Fed has hiked rates so much. So once we do begin to see the results of the Fed trying to slow the economy down, we will begin to see bad data in a number of different areas, and most importantly, in the labor market. And once that happens, credit spreads will start to widen. That means the cost of capital will begin to go up. Yes, the Fed may begin to respond to that by lowering the base rate. But if we do continue to see the slowdown, which is the logical consequence of what the Fed is trying to do, you run the risk that, yes, base rates might go down, but credit spreads will then be widening. And therefore, the cost of capital in level terms is not going to go down. In other words, the Fed only controls the base rate and not the spread in credit markets. And that's the reason why I think that a soft landing is very difficult, because we have a lag between the Fed so far saying hawkish, 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 and then the data starts to weaken, And then they need to turn the supertanker around and begin to say, well, now we'll be dovish. And in that period, we will have spreads widening, even if base rates start to move lower.